Okay, let's look now at what would make someone a material participant, meaning it would be an active activity. The income you earn from it would be active. Or when does it switch over to, now that's passive income. So a material participant means first of all, we'll have a whole separate video on this if it's a non-rental business. So anytime you're in this chapter and you're dealing with passive losses and there's a rental activity, someone is renting things out, you go, uh-oh, different category, alert, alert, alert. Let's move over here and think about that later. Okay, so in a non-rental business, losses from this kind of activity in which someone is a material participant, if you have that loss, it can offset other types of income. What other types of income? Well, portfolio and active. So if I have a loss from this activity that I'm involved in, and I am considered a material participant, but I also have salary and some dividend income, then I can go ahead and take that loss and recognize it on my tax return this year. Okay, what makes me a material participant then? Well, this is like a lot of other things with Congress. There's no one set thing that says, like we looked at with independent contractors and employees, you kind of have to look at a lot of things. With our hobby losses, you kind of have to look at a lot of things. Well, that's what we're going to do here. And there's really like these 7 factors. So first of all, we're going to start out with current participation. So current participation is just like it says, it's based on how much does that person work in the business. Again, it's not, oh, it's a restaurant. It must be material or passive. No, 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 no. Any business can be either active or passive. It just depends on your participation. So roughly this one, and you guys need to and can read about it in the book, but this is like a 500-hour rule. If the individual participates for more than 500 hours in the activity for a year, then you're a material participant. So let me see what that would be. 500 hours divided by, there's 52 weeks in a year. That's just not even 10 hours a week. Everybody ought to be working more than 10 hours a week, right? So it's not a super high threshold, but it just shows you're participating in the business. And then there's some other hours rules like, well, if you just participate for more than 100 hours during the year, man, that's pretty darn easy. But you're doing more than anybody else is, then you could be. So read through those. There's 3 or 4 of those in the current participation. And then we even have this prior participation section that we can look at where you go back to the last 5 years and it says, hey, if the taxpayer materially participated for any of like 5 of the last 10 years, then okay, they're still a material participant. And then this last one I love. Congress does things like this a lot. It's the facts and circumstances. This is when Congress didn't lay it out completely, and the IRS is trying to come in and fill in the gaps and help us gain some clarity. But they're like, based on all the facts and circumstances of the situation, um, if it's a regular, continuous, and like substantial basis that the individual is participating, then you're probably a material participant. And that's why you get a lot of court cases because we're like, I don't know, am I not? These are a little more cut and dry. And as a tax consultant, you can help your client figure out sometimes, y'all, you don't want to be a material participant. Sometimes you want that to be a passive activity because maybe I have several passive activities and this one over here is going to have a bunch of losses in the first few years that we're starting up. And I have this one that's going to have income. I want this one to be a passive activity so that I can net my losses with that passive income. But sometimes I want it to be an active activity so that I can go ahead and take my losses now. When I first got into buying Airbnb properties, really they're just short-term rentals, but you rent them often on the platform of Airbnb. There's all these podcasts that teach you how to, oh, they call it the short-term loophole, and all these people making people sign up for courses and pay all this money. We found this loophole in the tax code where you can take this loss as an ordinary loss. And that's all they were doing, teaching these rules of how to be an active participant. And as I got into it, I thought, well, I don't need to know that because I'm looking to make money in this deal. I'm not looking to have losses for forever. I only want to get into a business if I think I'm going to make some money and have some gains on it, right? So there's no one cut and dry what you need to do. All right, those are our material participation rules. You'll notice up here I have the words limited partners written there. So limited partners, and I go over this, there's a whole lot to it. This is not a partnership course, this is an individual course. But for purposes of this, if your problem tells you so-and-so is a limited partner in this activity, then you may go ahead and assume that they are a passive participant. So that activity is going to produce passive income and losses to them. So generally, limited partners, it means their liability is limited. They've only invested 40 grand. That's the most they can lose is 40 grand. Even if the company goes out of business and owes people $1 million, I can only lose my 40 grand. I am limited in my liability, right? So I mentioned that so that you know when you come across that in a problem. Okay, so now what we need to do is go back and focus on this non-rental versus rental business. Okay, first let's look at our rules and then we'll work a problem. So when you're dealing with rental income, there's a big general rule that says all rental activities are passive activities. But Jennifer, what about those material participation rules we just talked about? What if I have rental income, but I materially participate? Doesn't matter. The general rule says you're reading that problem or you're talking to your client who says I have rental real estate and I have income from it. Boom, it's passive. I don't care what else. Except for we know we do care because there's always exceptions in tax and exceptions to the exception. So let's get to our exceptions. First of all, though, does that make sense? Is this a good or a bad thing? I've got rental income or a loss. It's going to be passive. I don't know. It's not necessarily good or bad like we just talked about, right? It is, and it will be subject if you have a loss to the passive loss limitation rules. Okay, so what are our exceptions when we might have some rental income that would not be considered passive? Well, we have two exceptions. One is for real estate professionals. Okay, I got some rent houses. Am I a real estate professional? Well, here are the rules. If more than half of their services are in real property, well, that makes it a little harder for me to be a real estate professional now because the IRS knows that I've got a real job at UT Tyler that I work year round and I'm providing services as an employee. So, is it possible that more than half of my time could be spent in real property? Makes it a little harder, right? And more than 750 hours of services in real property. This is higher than that 500-hour of material participation rule we just looked at, right? So if I want to escape this rule that says my rental income or rental losses are going to be passive, and I'm a real estate professional, then more than half of all the services I provide got to be in real estate, and I have to spend more than 750 hours a year in real property. Okay, that's one. Two, anyone can take an exception to this rule up here on up to $25,000 of real estate losses. So anyone, whether they're a material participant or whatever's going on, says, if you got some losses from real estate, go ahead and take 25,000 of them this year. What does that mean, take 25,000? It means I can recognize that loss on this year's tax return, even if I only have portfolio and or salary income. Okay, but it's just 25,000. And here's the kicker. Here's why a lot of people can't take this. It's only for people whose AGI does not exceed $100,000. Sounds like a big number, but there aren't a lot of people making less than 100,000 who just have extra money to go invest in real estate. Happens some, but you don't see it too much. So once your AGI hits 100,000, this 25 grand that you could have taken starts getting phased out. You know, sometimes our phase outs go dollar for dollar. not this one. It goes 50 cents of every dollar. So every dollar you go over 100,000 AGI, you start losing your ability to take a $25,000 loss. So what's the maximum AGI? When do you completely lose your ability to take this loss? When your AGI is $150,000, right? Then you've gone over it by 50 grand. 50% of that would be 25 grand, and now you've wiped out all of your ability to take that loss. Okay, let's look at a problem with that. Okay, I have another problem on the board here with Brad. He has an AGI of $90,000 before he ever looks at his rental activities. We know that's going to affect his AGI also, but we're just pushing that aside because our general rule says, hey, if you've got real estate activities, those are always passive unless what? Unless you're a real estate professional at 750 hours, or unless it's anybody and you can take up to 25 grand. Yeah, but he has 85 grand. Okay, but with any type of passive losses, we can always net those with what type of income? Any type of passive income. So whether it's other real estate or just any kind of passive income, we can always net passive against passive. So when I look at this, he's got an $85,000 loss from real estate, 30,000 of income from real estate, and 36,000 of just other kinds of passive income. The first thing I'm going to do is net his real estate income and losses. Those are both general rule passive. Passive can always go against passive. And that would be what? A $55,000 real estate loss. Okay, can I net that with this passive income? Yes, any passive income can always be netted. You just can't do passive losses against active or portfolio income unless you fall under one of those exceptions, right? Okay, so now, hush, Murphy. So now Murphy had some input on that. We're gonna net this $55,000 with 36,000 of passive income, and that would give me what? I'm still left with a $19,000 passive loss. Okay, make sure you're following me with where the numbers came from. I just netted these two things. So not only is this a passive loss, it is important for me to figure out what type of passive loss, because if it relates to rental activities, real estate activities, then I might can fall under one of those exceptions. Remember the real estate or the, hey, any old Joe Blow can take the 25 grand. So sure enough, this is where all my big fat loss came from. So yes, this is still a real estate loss. Okay, what are my rules? Who can take that? Anybody. Up to what amount? 25,000. If my AGI is not over 100 grand, okay, I'm good. Brad gets to take this because it's real estate and it's less than that 25K max. So that would be what, $71,000. Y'all know I hate doing math when I'm talking and blah, hopefully that's right. Okay, let's talk about a couple of things. What if we ended up with this net loss and it was not from a real estate activity? Then what? Then he could not recognize or take any of it this year on this tax return. It would just have to be carried over to next year. All right. What if we ended up with, say, $28,000 of a loss left over? Well, only 25 of it could be taken this year under that exception for real estate. Make sense? This is one of those, it's got a lot of different twists and turns to it, but it's just one where you need to practice a lot of different examples. So make sure you work the extra examples I give you, the homework. You can ask ChatGPT to come up with it, and that'll really help you get that nailed down.